There's a question most traders never ask themselves, and it might be the most important question in trading. Is my psychology actually broken? Not struggling, not learning, but fundamentally working against me. Because here's what nobody talks about. A broken strategy shows up in your results immediately. You see the losses, you adjust, and you move on. But broken psychology can hide for months. It disguises itself as bad luck, as the market being irrational, as needing a better indicator. And meanwhile, the same patterns keep repeating. The same mistakes showing up in your journal, if you even keep one. Today we're going through 7 specific signs that your trading psychology is running the show instead of your strategy, and more importantly, the exact frameworks that fix each one. If 3 or more of these described your last trading week, this is not a strategy problem. This is a psychology problem. Sign number 1. You need the next trade to win. When you enter a trade, not because the setup is there, but because you need to recover from the last loss, you've crossed a line. The trade is no longer about the market, it's about you. And the market does not care about your account balance. When you need a trade to win, everything changes. Your entry gets looser because you can't wait for the perfect setup. Your sizing gets bigger because you need to make up ground faster. And here's the cruelest part. Even when a desperation trade wins, it reinforces the worst habit. It teaches you that entering without a reason can be rewarded. That one win will cost you 10 losses down the line. The fix starts with one honest question before every trade. Am I entering because the setup is here, or because I need this to work? Sign number 2. You carry emotion from closed trades into new ones. I call this trading ghost positions. The trade is closed. Your capital is back in your account, but emotionally, you're still in it. That last loss is whispering that the market is out to get you, or that last win has you feeling invincible. Either way, the closed trade is contaminating the next entry. If you hesitate on a valid setup because the last trade lost, that's a ghost position. If you enter aggressively because the last trade won, that's a ghost position inflating your confidence. Each trade is supposed to be independent, and your psychology has to match. The fix is what I call a closed trade completion ritual. When you exit, write one sentence. That trade is complete and I am separate from its outcome. It sounds simple, but it creates a habit of closure that breaks the emotional chain between trades. Sign number 3. You move your stop loss. This one is the silent killer because it always feels rational in the moment. The price is approaching your stop and you think, let me give it a little more room. Maybe the market is just shaking me out. So you widen it a little, then a little more. And before you know it, your planned 1% risk has become 3%. Or worse, moving your stop is not analysis. It's negotiation with an outcome the market has already decided. The price hit your zone. The thesis is invalidated. And instead of accepting that, you're arguing with it. What moving a stop communicates is simple. Your pre-trade analysis was wrong. But instead of respecting that, you're choosing in-trade emotions over your calm, clear-headed plan. If you move stops regularly, start tracking it. Write down every adjustment and what happened next. The data will cure this faster than willpower ever could. Sign number 4. You check your positions every few minutes. Your phone is in your hand, the chart is refreshing, and you're watching every single tick like it matters. But surveillance is not control. Watching a position more closely does not make it perform better, it makes you perform worse. Every time you check, you give your emotions fresh data to react to. A small drawdown that would be meaningless in 2 hours becomes an emergency in real time. A small gain that needs time to develop becomes a temptation to lock in too early. Traders who check constantly are confusing attention with influence. They feel like watching is productive, when really it's feeding anxiety with more information than their emotional brain can handle. If you recognize this, try a simple experiment. Place a trade with your stop and target set, then close the platform for 2 hours. What you feel during those 2 hours will tell you everything about whether you trust your own process. If that last sign hit close to home, drop a comment below and let me know which of these signs describe your trading. Naming the pattern is the first step to changing it. Sign number 5. You size positions differently based on how you feel. After a winning streak, you bump your size because you feel confident. After losses, you cut your size because you're scared. Both decisions are wrong. Sizing up after wins is overconfidence disguised as momentum. You feel like you're on a hot streak, and you reward that feeling with bigger risk. But the market doesn't know about your streak, and your next trade has the same probability as every other. Sizing down after losses is fear disguised as risk management. You tell yourself you're being careful, but you're letting the last loss dictate the next trade structure. Consistent position sizing is one of the clearest markers of psychological stability. If your size changes based on emotion, your risk management is an illusion. Sign number 6. You enter trades without a clear, rule-based reason. You look at a chart and something feels right. The price action looks like it wants to go up. There's a gut feeling, and you enter. But real intuition is earned through thousands of hours of deliberate practice. What most traders call intuition is unresolved emotion wearing a convincing disguise. That anxious need to be in a trade dressed up as a market read. That fear of missing out, wearing the mask of opportunity. If you can't write down your specific entry rule before you click the button, you don't have a reason, you have a feeling, and feelings are not a trading strategy. The pre-trade audit fixes this. 3 written questions before every single trade. What is my specific rule-based reason for this entry? What is my emotional state right now? And am I genuinely okay with this trade being a full loss? If you can't answer all 3 clearly, you don't take the trade. Sign number 7, and this is the one that surprises people. You feel anxious when a trade is actually winning. The price is moving in your favor. Your thesis is playing out, and instead of feeling calm, you feel rising tension, an urge to close it, to lock in profit before the market takes it back. This is the psychological thermostat. Somewhere inside, you have a set point for how much profit you believe you're allowed to make. When a trade exceeds that set point, your psychology creates anxiety to bring you back down. It whispers that this is too good to last, that you should take the money and run. The result is cutting winners short and letting losers run. The exact opposite of every proven principle. If you feel anxious when winning, your thermostat is the problem. You are allowed to feel good about a running trade. That feeling does not require action right now. Let me tell you about a trader named Daniel. He was technically excellent, understood market structure, had a proven strategy, and his win rate was solid. But for 11 months in a row, he hit the exact same profit ceiling, $3,000. Every single month he'd build steadily, and then somewhere around that mark, he'd give it all back. Not through one catastrophic loss, but through subtle self-sabotage. He'd widen a stop here, overtrade there, take a setup he knew was mediocre. When he finally worked with a performance coach, they asked what he felt when his account approached $3,000 in profit. Daniel said something that changed everything for him. It feels like I'm about to get caught, like making money is something I'm not supposed to be doing. His thermostat was set at 0. Anything above that felt like borrowed time. So his psychology made sure it was. Daniel's story is more common than you think. Many technically skilled traders have a profit ceiling they can't explain with logic. Their strategy works, but something keeps pulling them back to a set point. And that set point is almost always about identity, not the market. The thermostat resets because the trader doesn't believe consistent profitability is something they're allowed to have. So, how did Daniel break through? He started scoring every trade on process before looking at profit or loss, 1 to 10 on execution quality. Did he follow his entry rules? Was sizing consistent? Did he let the trade reach its target without interference? Over 3 months, Daniel noticed something remarkable. His highest scoring trades were also his most profitable, and his lowest scoring trades were clustered around that $3,000 zone. The ceiling wasn't in the market, it was in his execution. And execution broke down whenever his psychology detected undeserved profit. Now let me give you the complete framework that ties all 7 signs together. Recognizing the signs is only half the battle. You need a system for interrupting the pattern before it costs you money. The pre-trade psychological audit is 3 written questions you answer before every trade. Question 1. What is my specific rule-based reason? If you can't write a clear answer, you don't take the trade. This eliminates sign 1 and sign 6 immediately. Question 2. What is my emotional state right now? Calm, frustrated, excited, anxious, or numb? Just naming the emotion reduces its power. Research on affect labeling shows that putting feelings into words activates the prefrontal cortex and dampens the amygdala. Question 3. Am I genuinely okay with this trade being a full loss at my planned stop? Not theoretically, but genuinely. If the answer is no, your sizing is too large or your psychology isn't ready. 3 questions, 30 seconds, and it addresses 5 of the 7 signs we covered. The second tool is the process score, and this is what broke Daniel through his ceiling. After every trade, before you look at whether it won or lost, you score your execution 1 to 10. Did you follow your entry rule? Did you keep your original stop? Did you size consistently? Did you let the trade reach target or stop without interference? Track this as your primary metric, not profit and loss, but execution quality. Here's why this works. When profit is your primary metric, every losing trade feels like failure, even with perfect execution, and every winning trade feels like success, even when you broke every rule. Process scoring flips that. A perfect execution that loses gets a 10. A sloppy entry that wins gets a 4. Over time, your brain internalizes that following rules is the goal, not the outcome of any single trade. Trust is the knowledge that regardless of what this trade does, you will follow your rules. Process scoring is how you build that trust. If you've made it this far, subscribe and let me know in the comments which sign described you the most. We go deep on trading psychology every week with tools you can use in your next session, not theory, but practice. Here's your homework. Go back through your last 10 trades and score each one on process, 1 to 10. Don't look at profit or loss first. Score the execution, then compare. I guarantee your best executed trades cluster around your most consistent profits, and your worst executed trades cluster around the losses that frustrated you most. That pattern is your proof that psychology, not strategy, needs fixing. Then for the next 5 trading days, run the pre-trade audit. 3 questions written down before every entry. When you close a trade, write the completion sentence. That trade is complete and I am separate from its outcome. Score your process. These 3 habits will change your trading faster than any new indicator ever could. We started with a question. Is your psychology broken? Now you have 7 specific ways to diagnose it. You need the next trade to win. You carry ghost positions. You move your stop loss. You check positions every few minutes. You size based on feelings. You enter without a rule-based reason. And you feel anxious when winning. If 3 or more describe your last week, this is not a strategy problem. But here's what I want you to remember. Recognizing these signs is not a weakness. It's the beginning of real strength. Daniel didn't break through his ceiling by finding a better strategy. He broke through by measuring what actually mattered: his process, his execution, his psychological state before every trade. The tools are simple: an audit before the trade, a completion ritual after, and a process score that measures what you can control. Broken psychology is not permanent. It's a pattern, and patterns can be interrupted. Your next trade is a chance to prove that.